Here I have with me the first page of the 96-page contract outlining my option to purchase a property in Australia. And that works exactly like an option contract in the stock market. Hi, my name is Bang. I've been trading options for almost 20 years. You have heard about options, and that is something you could make a lot of money. But it sounds very complicated, right? In this video, I will explain to you option trading in the simplest way that even your grandmother can get. No jargon, no long technical term. Let's go! Remember the property in Australia that I mentioned earlier, where I purchased? It was our family vacation trip in Brisbane 2 years ago when we got attracted to one of the iconic property that is under construction at that point in time. And when we returned to Singapore, we did some study and we decided to purchase that condo unit. And the cost of the unit is about $700,000, and we decided to put out a deposit of 10% of the value, which is $70,000. Now the project is still under construction. 2 years has passed now, and it's still 2 years to go before I can receive the key. But the property price has gone up significantly. Now, at this juncture, I have two choices. One, I can flip the property for a significant profit. Two, I can wait for another 2 years to receive the key and pay the remaining 90% to own the property outright. So if I do the first one, which is to flip the right to buy my condo for a profit, that is similar to selling the option that I'm holding for a profit. But I follow the second choice, which is to wait and hopefully get a more value out of the property and own it eventually. It is similar to exercise my option and convert it into shares and own the shares outright for long-term investment. Now let's talk about option in the context of stock markets. Let's start with the call option. So the call option is a contract that allows the call buyer to have the right to buy 100 shares at a strike price. Similar to my case when I bought the condo unit at $700,000, that is my strike price on or before the expiry date. So for example, look at the stock of Apple. Let's assume it is trading at $155 per share right now. Somebody would like to buy a call option with the strike price of $155, expecting the stock price to go much higher from here. For him to have that right, he has to pay a premium. Let's call it $2 per share. And one contract is equal to 100 shares. So he pays $200 for the premium for one contract. And that $200 premium is similar to 10% deposit that I put down for my property in Australia. Now let's look at the transaction from between the buyer and the seller here. The buyer of the call pays $200 for the premium, and he expects the stock price to go higher to make money. On the other side, the seller of the call option receives the $200, and he has obligation to sell the stock or the shares at $155 per share, even if the share price goes much higher. So that's what happens between the buyer and the seller of the call option. So obviously, the seller of the call option doesn't want the stock price to go much higher. On the other hand, the call option buyer wants the stock price to go higher to make money. Like in my case, I want my property in Australia to go up in value over time to make money. So in this case, if you look at the two scenarios between buying 100 shares of Apple or buying one call option on Apple, what is the difference? Well, if you buy 100 shares of Apple, you would need to have $15,500 capital to buy 100 shares, which is a significant capital for many people. And let's say if the stock price goes up by $10, then you would make $1,000 profit for 100 shares. That would translate into about 6.5% return on investment. On the other hand, if you buy a call option at the strike price of $155 and the stock price goes higher to $165, you would make $1,000 profit. Your call option would increase to $1,000 as well, but because you pay $200 as a cost of it, your net profit would be $800 in absolute. But because you use only a fraction of the capital, which is $200, that would translate into 400% return on investment. So you see the power of options, right? You can magnify your return on investment significantly because you use just a fraction of the capital. So the key points here are, number one, the call option allows the buyer to protect the downside risk. So in the worst case scenario, if the stock price goes down to zero, you would lose maximum the amount of money you paid. So in the case of Apple, you would lose maximum $200. That's it. You cannot lose more than what you have paid. Number two, with a small amount of money, you can control a large amount of stock. With only $200 of premium that you pay, you can control the amount of stock that is worth like $15,500. You see the leverage there? And number three, if the stock price happens to go higher, you don't have any limit on the upside. You could make unlimited upside profit. And that's the beauty of the option. Now let's just talk about the concept of put options. And let me use the real example where I bought an insurance for my home. Let's say the home is worth $1 million. Every year, I need to pay an insurance, they call it fire insurance for my home. And I paid $150 per year. And let's play out two scenarios here. Number one, what if my house gets burned down to the ground? Guess what? I will be able to claim back $1 million worth for my house, and I can buy the new one, and I only lose $150 of the premium. Scenario number two, if nothing happens and the house value will continue to be $1 million or even higher, I just lose $150 premium. And that is still better than doing nothing, right? And I would like to renew the contract every year again. So that's the concept of buying an insurance to protect an asset for yourself. And that brings the concept of put option in the stock market. A put option is a contract that allows the put buyer to sell 100 shares of stock at a strike price on or before the expiry date. Like I can sell my burned down house at $1 million value and recuperate on the losses. So that's the concept of put option. You can sell your share, even your share collapses. So for example, I'm sitting on very good gain from Meta, the stock that has been flying. I look at the chart of Meta, it is looking really good. I'm very confident that the stock price will continue to grow in the future, and I want to hold it for the long term. But because the stock price has gone up so much, I'm just a little bit concerned that, hey, in the upcoming earnings, and the stock price could plunge. So to have a peace of mind, I could choose to buy a put option on Meta, let's say expiring in September, at the strike price of $500. I can sell, even if the stock price plunges, I can still sell my Meta stock at $500 per share. So that is the insurance for my stocks, right? And I have to pay a premium for it. Let's say I have to pay $30 for the premium. Or one contract is 100 shares, so I need to pay $3,000 for that protection. And that's good for 3 months. Now let's look at the transaction between the buyer and the seller of the put option. So if the stock price goes down, I can sell my put option for a profit to offset the loss in my shares. On the other hand, the put seller, the one who sells the insurance to me, will have the obligation to buy my Meta shares even if it collapses. And that is his obligation. So that is the benefit of buying an insurance to protect my shares. Here's why I love trading option. Number one, it uses less capital. I show you the case of Apple, right? You use a fraction of the capital to have exposure to a big amount of stock. That's the beauty of the option. And because of that, when you make money, it will magnify your return on investment. In the case of Apple, you could make 400% return on investment instead of just 6%. Number two, as I said, because you use less capital, it will turbocharge your return on investment. And because of that, you could easily outperform the market very consistently. Number three, you can make money in various market directions. It goes up, it goes down, it goes sideways. You could make money in all market directions. Because unlike trading stocks, where you can only buy or sell, trading options, you have so many combinations, different strategies that will be suitable for different contexts. Sometimes it's bullish, sometimes it's bearish, sometimes it's neutral. Sometimes you are bullish on the long term and neutral or bearish on the short term. Or sometimes you neutral now, but then there will be explosive up or down. So there are many ways for you to construct your option trades so that you can benefit from different phases, different setup, different market environments. Number 4, you can use option to potentially buy fundamentally good stocks at a discount. And you know what? Warren Buffett himself has done it many times. He uses option to buy good company at the price he likes to buy. And not many people know he is one of the biggest option traders in the world. He often sells puts on companies he wants to acquire. He sold a put option on it with the intent to, number 1, potentially buy the stock at a discount. Number 2, he could also avoid the public eyes as well, because normally people just look at his holding, not the options. Number 5, you can use option to increase the win rate for your trades. Unlike trading stocks, where you technically have 50-50 chance because you don't know the stock price will move up or down, it's really 50-50 chance. But in option trading, you can construct different trades. Some are very high probability of winning, could be as high as 90%. Some could be like 70-80%. That's where normally I construct my trade at. And you don't have to settle for 50-50 chance. And really, with different strategies, you can choose the one that fit to your risk tolerance. So if you are an investor, you can use option to protect your investment portfolio. The same way I buy fire insurance to protect my property. You could also generate extra incomes out of your stock holding, the one you already own. You can now sell option on top of that to generate regular incomes. And finally, you can also use options to buy fundamentally good stocks at a discount. If you are a trader, well, you can generate profits from any market conditions, up, down, sideways. Or if you are like me, I use option to invest because I use much less capital for it, and hence it could boost my return on investment significantly. And the best thing is, when you magnify your returns, it doesn't mean you will increase your risk. In fact, it can help minimize your risk as well. And here's the kicker. Though trading options could be very rewarding, reality is most option traders lose money. In fact, 90% of option traders are losing money. So make sure you know what you are doing. If you are just starting out, check out our free resources in the link below, explaining the basics of option trading, and it is packed with many real-life case studies. This is Pham from Piranha Profits, signing off. Until next time, keep winning.